Verizon Communications Inc., ticker symbol VZ, is currently trading at $38.18 a share. This is a favorite among dividend investors due to its massive 7.1% dividend yield. This has a track record of increasing its dividends over time and is an appealing stock to income-focused investors. Also, this is one of the top constituents of SCHD, which is Schwab's US dividend equity ETF. You can see here it is second in the holdings by weight. So what we're going to be doing today is looking at the company's financials, seeing if it is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So just quickly looking at the stock, as I said before, it has a very attractive dividend yield. It's got stable cash flows, reliable revenue, and also a lot of 5G growth potential. If we look at the stock over the last year, been pretty up and down, highs of around about $45 a share, lows at about 37. So over the last year, this is pretty much the lowest it's been. Is this the right time to buy? So if we go to my automated stock valuation spreadsheet and put in the ticker VZ, this will load all the latest company financials. If you're interested, check out my Patreon, but we'll talk about that more later. So it loads all the data here. We have VZ, Verizon Communications Inc., $38 a share, $160 billion in market cap, PE of 16.46, which is a lot lower than the market average, which is currently 30.4. Earnings per share, $2.32, and a beta of 0.46, meaning it's a lot less volatile than the market. Analysts saying it is a big buy. $47 a share is the target price. Quite interesting. So here we have the dividend yield here, 7.08, which means you'll get paid $2.70 per share. They pay around $11.4 billion in the total dividend. Payout ratio in terms of the net income, currently actually higher, 116%. But if we look at the historic net income, this has been sort of a down year. It was $11 billion the year prior, 21, but we'll talk about that in a second. And in terms of the free cash flow payout ratio, 83%. So it can be paid, yes, but not on the safe side. If you want to get paid this dividend, buy before the 10th of April and you'll get paid your quarterly dividend. So let's jump into the revenue here. Revenue currently $134 billion. You can see here Verizon's revenue is pretty consistent. All-time highs was back in 2022. It's dipped slightly but increasing again, but pretty consistent revenue over the last, well, this goes back to 2009, but definitely since 2015, the revenue has been consistent. Are they able to generate more profit out of it? Current answer is no, 9.8 billion. It is down from 22 and 23. If we look at the stock price over the last 5 years, you can see that the stock has reflected this, but it hit a bottom of around about $30 a share in October of 23 and is at about 25% since then. But you can see 9.8 billion. Free cash flow, 13.69 billion. It's increased over the last 2 years. It was negative in 21, up in 22 to 10 billion, 13 just shy, and now 13.69. So if we look at operating cash flow versus capex, operating cash flow is decreasing slightly and capex is up, which is why the free cash flow is down ever so slightly from the prior years. Shares outstanding though, you can see that they have issued more shares. There has been a split here that has not been reflected correctly. They did do a brief buyback, but have started been issuing more shares, hopefully using that money to generate more capital. Now we'll look at the discounted free cash flow model. This is a way of calculating the future free cash flows. Sorry, let me say it again. This is a way of estimating the value of investment using its expected future free cash flows and discounting them to today's value. A bit tongue twisted there. So based on averages, let me have a look. $64 a share. Also, if we were to bring this up, we'll bring the discount factor up about 6%. Currently, weighted average cost of capital is 4.9, but we'll bring it to 6. $45 a share. Now let's have a look at these numbers and see if we agree. Revenue, less than 1% growth, 135 and 136. I think that's a fair number, but let's see what analysts are saying. Analysts are expecting a bit more bullish, actually. 134 and 137. So we'll just do 1.5%. No, we'll do 1.25. Oops, typed in the wrong field. My mistake. 1.25. Now puts it at $45 a share. Net income margins I'm pretty happy with that 12%. See, here we go. Now this is where things are going to get interesting. If we take an average of these years, ignoring, we'll take an average of these years. We'll take out the high and the low there. 92%. This is going to throw the stock massively up, $120 a share. So if we bring these net income margins down to about 7.3, which is the last year, and then we even increased the weighted average cost of capital to about 8, puts it back at about $48 a share. But I think these are more realistic in terms of the free cash flow growth, the revenue growth, and even the I don't know. I think the net income margins are a bit low. Let's put it at 8%. But you can see $50 a share is more of a fair price. Dividend discount model. Let's have a look at what this does. We'll bring the weighted average cost of capital in line to what we saw here, which was at about 8% and 2% on the average growth. $45 a share. So quite interesting there. Slight buy on the dividend discount, which is quite good. Ben Graham formula for intrinsic value. Let's see if it likes the stock. Ben Graham has not liked a lot of the stocks at the minute due to the high bond yields. 3% growth over the next few years. No, it's not going to like it again. Let me just check if this number has changed. This is the Moody's seasoned AAA core bond yield, still 5.12. Now, if we were back in 2020 with 2%, 2.25%, it would be a buy, but unfortunately we are not. So Ben Graham does not like the stock. So finally, let's have a look at the comparable company model. This is a way of valuing companies, looking at their competitors of similar sizes and similar industries, and we can do a comparison here. So some stocks that I think are immediately, we'll go with T, which is AT&T. This is a direct competitor which offers services in wireless, broadband, and media. Next one, we'll do T-Mobile, T-Mus, once again, wireless. And finally, we'll do Comcast, CMCSA. And this will load up all the company's financial data. So if you're interested in the sheet, check out my Patreon. It's the $4 tier. You get access to the sheet and all the data that the sheet provides. If you want the slightly higher tier, that's $7 a month. Or if you just want to help me out for $1.50, that'd be very appreciated. But I would say, if you are going to do it, purchase the sheet because I think it's worth it. I use it myself, as you see in these videos, and a lot of people are enjoying it at the minute. We're a growing community, and I'm very appreciated that you guys are find my stuff interesting. It's really good. It means a lot to me. But anyway, enough of that sappy stuff. So we have enterprise value. Verizon is the second biggest, only under T-Mobile. Oh, and just talking about this, sorry, we look at the revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, Peter Lynch's price to earnings growth. But then the specific metrics we look at, EV to revenue, EV to EBITDA, PE, and forward P. So Verizon, second largest. They're all pretty similar. Revenue, interestingly, is the highest. Revenue growth rate is the slowest. T-Mobile is the highest, and they also have the smallest revenue. EBITDA, highest. Net income, all pretty close. But not the highest. Profit margins, actually lowest profit margins, even lower than AT&T. Price to sales, market average is around about 3.1. They're all a lot lower than that apart from T-Mobile. Price to book, market average is 5.22. Once again, T-Mobile is in lower pack. Peter Lynch's price to earnings growth, ideally this wants to be under 1. Verizon is slightly higher than 1, but it is towards the bottom of these again. EV to revenue, looks like T-Mobile brings it up, but it's the middle of the pack. EV to EBITDA towards the lower. So you can see here, it's on the average. And PE, one of the lower ones. And forward P, one of the lower ones as well. But pretty varied prices here. Gives us around about $51 a share. So discount free cash flow says it's a buy. Dividend discount model says it's a buy. Ben Graham hates it. And the discounted free cash flow model as well thinks to buy. Puts it around about $50 a share. Analysts as well, as we saw at the start, puts it at around about 57. So all the models are saying is a buy, quite interestingly, but also does pay a very nice 7.10 dividend. Right guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.